Healthcare stocks have been under pressure here in the United States as increasing regulatory pressure is weighing on investor sentiment. In this video, I'm going to evaluate Oscar Health, look at the two biggest or three biggest risks the company is facing right now, and then I'll share with you my proprietary discounted cash flow valuation model, which calculates a fair value for the stock today. And then I'll also look at valuation on a forward price to earnings basis. I'll bring it all together and answer the question if I think this stock is a buy at current market prices.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so one of the biggest risks here for Oscar Health is the dependence on the risk adjustment programs. So Oscar's cash flow and profitability are significantly affected by the timing and magnitude of risk adjustment payments. For instance, in the third quarter of 23, the company anticipated a payment of approximately $1.4 billion into the risk adjustment program for the 2022 policy year. So delays or changes in the timing of risk adjustment payments can lead to fluctuations in operating cash flows, impacting financial planning and stability. Now, whenever you're dealing with these kinds of programs and risk adjustments, there are many estimates and assumptions that are going into these models, and changes in those estimates and assumptions can change the payments given to Oscar Health. So this is a risk for the business, and this is something that investors should be aware of for Oscar Health. The next thing I'm going to highlight are regulatory and compliance risks. So complying with the ACA and other regulations requires significant resources and expertise. The company must employ people and personnel and teams to deal with these regulations and regulators. But the healthcare companies, including Oscar Health, have been really good at this. They have great strategies for dealing with regulators and regulations. And something that I found interesting, I don't know if it should be allowed or not, but people who work at regulators for a couple of years or for a few decades, maybe in the public sector, can eventually go to the private sector and work for companies like Oscar Health, bringing these kinds of companies the expertise they gained working at regulators, right? And so those employees are highly valued by companies like Oscar Health because they bring with them years and years of expertise in working at the regulators, and they bring insights and provide those insights to the private company in how to deal with the regulator most effectively. So there are some state level variations that Oscar Health has to deal with because they operate in multiple states and each state has their own regulatory requirements. So that increases complexity and the cost of compliance. They can't just have one team that deals with the United States market nationally. They have to have perhaps several teams that deal with regulations on a state by state basis. So changes in healthcare policy, including the potential repeal or modification of the Affordable Care Act, can materially impact Oscar's business model and operations. And of course, every administration that comes in, especially Republican administration in the United States, talks about repealing the Affordable Care Act. And there's always that chance that they gain enough support to repeal that Affordable Care Act, and that could mean significant changes for Oscar Health. The last risk I'll highlight are operational challenges. Any disruption or failure in Oscar's technology infrastructure can impair service delivery and member satisfaction, and this rapid growth in the business may strain existing systems and processes, impacting efficiency and service quality. They may not be able to serve a larger customer base and experience something that's called inefficiencies in scale, where a business, as it grows larger, becomes more inefficient because they don't have the capability to serve that many customers. And so, as more customers sign up, the quality of service declines. And that's something that healthcare companies, especially, have a growing risk to, because healthcare is so much a touch business, meaning that it requires contact with customers, speaking to customers, seeing customers in person, and that type of business is more difficult to reach at large scale. It's more difficult to operate effectively at large scale. All right, so now that I've highlighted the biggest risks Oscar Health investors face, let me share with you my proprietary discounted cash flow valuation model. And I've done this for hundreds of companies. And I've got videos, member exclusive videos going through these breakdowns in more detail. If you're interested in that, join as a channel member. We'd love to have you on board. It's less than $5 a month. I think it's the best deal on YouTube. In this video, I'm going to focus on the outcome of that calculation, which is the intrinsic value per share. For Oscar Health, I have it calculated at $42. The current market price is only $17. So much like many of the healthcare stocks I'm following, their shares look undervalued when using my proprietary discounted cash flow model. Now, healthcare stocks have been under pressure, and my conviction on these valuations is not as high as it would be for other types of business because of the increasing risks to regulation and the uncertainty regarding regulation and how it will impact the business. How much will their cash flows be impacted if there is regulation? And the risks are certainly higher today than they were a year ago, 2 years ago, and 5 years ago. So that's something I'm paying close attention to with a company like Oscar Health. So this is one of those high risk, high reward situations if I'm looking at the valuation and the recommendation. I also looked at this business valuation on a forward price to earnings basis. And on a forward PE, it's trading at 41, which is relatively cheap if you look at the history of the valuation of this business. It's growing revenue quickly. The free cash flow is expected to grow at a relatively strong pace. The margins are not so great so far, but it's still expanding. So the valuation on the forward PE basis doesn't look as cheap as the valuation on the discounted cash flow basis. So bringing it all together, Oscar Health scores very well on valuation. It scores relatively low on risk. It scores, I would say on average across my other factors that I evaluate when I'm looking at a stock. I look at 6 things, and Oscar Health overall, I would rate the stock as a buy, incorporating valuation, incorporating risks, incorporating the opportunity, all things being equal. I would rate the stock a buy, but with the asterisk of being a high risk business. So this is something for investors that have a higher risk tolerance. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.